Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen & Partners, to our fifth weekly update of global strategy and market outlook. On slide 2, as I regularly do, I've updated the latest cases around the world, and I use the number of days since 200 cases were reported in 1 week for the countries listed on the right. I'm glad to say these curves continue broadly to flatten, and indeed the infection rate seems to be a little lower than academic models had previously predicted. Of course, there's bad news. I'm afraid we've passed 2.1 million overall cases, and a surprise upsurge in Singapore, Russia, and Wuhan. Singapore and Wuhan probably on different reporting numbers. But this is a week where we saw President Trump outline his 3-phase program for reopening the US economy. And this gradual phased approach, in line with what I showed you 2 weeks ago in these talks, seems to be a template for the rest of the world. But we must be careful. It was also a week where the WHO director, the World Health Organization director, called for extreme caution when transitioning to more flexible social distancing measures. This week, I'm going to look at the impact on the global economy from these measures and see what that means for world financial markets going forwards. Let's begin on slide 3 with the economy that's most advanced in the COVID cycle, which is probably China. We've just had the GDP numbers out, an astonishing 6.8% downturn. Looking on that chart, I've taken the numbers back to 1992. There's nothing like it on there. Look at the relatively modest fall by comparison we saw in 2008-9. In fact, you have to probably go back to the end of the Cultural Revolution to see numbers like this in the early or mid-70s. On the right-hand side, some slightly better news. Dramatic falls a month ago in fixed asset investment, industrial production, and retail sales, but the beginnings of a turnaround, particularly in industrial production, where state-owned enterprises are beginning to crank up production under guidelines from government. So that's probably the most advanced economy. Let's move next to the United States on slide 4. Hard data for March is just beginning to come in. We've seen retail sales down 6% already. Those numbers will probably be significantly worse as we look today. And on the right, industrial production starting to fall sharply to minus 5.4%. It was also, though, a week where we heard a very high frequency number, which of course is unemployment or initial jobless claims. 22 million jobs now lost because of COVID-19. Add that to the round about the 5 million unemployed that were in the economy pre the crisis, and you have 27.6 million unemployed, or somewhere around 17% of the workforce. Now, we're not seeing any pickup yet, of course, but if we follow the Trump model, and that is replicated gradually state by state, perhaps we will begin to see a rebound in line with or similar to those China numbers. Turning to slide 5, we're looking at the UK. Here I've used the Office for Budget Responsibility report that was issued last week, and these slides are from that. This is a less detailed analysis and more a scenario, but it shows a particularly sharp drop for the UK, albeit with a particularly sharp recovery. 2 key assumptions: one, that the crisis or the actual lockdown will only be 3 months in duration, that's a big if, and secondly, that most of the side effects will have fallen away 3 months after that. Again, probably a bold assumption. The resulting 13% fall in annual GDP in 2020 exceeds any fall during the war, or certainly in the global financial crisis. Now, I think that number's large. The IMF has got a number more like minus 6.5% issued this week, but it shows how the impact on the UK economy is particularly severe. On that right-hand box, you can see the implications for unemployment. Nothing like the scale of the jump in the US, rising at peak to 10% versus their 17 already, and tailing off quite quickly. That, I think, is a result of Chancellor Sunak's active job protection programme. Turning to slide 6 again for the UK, you can see the impact on government borrowing. Totaling 273 billion, or 14% of GDP they estimate at the worst point. And quarter on quarter, it probably means that for the UK, our total borrowings briefly exceed 100% of GDP. Now, this sounds like a scary number, but it is the correct response in a crisis of almost warlike conditions to spend to mitigate layoffs and bankruptcies, but the numbers are large. On slide 7, the OBR, the Official Office for Budget Responsibility, helped break down the cost of some of these programs. I'm sorry it's a busy slide, but if you look for the direct effect of government decisions, we're injecting almost 100 billion into the economy, or somewhere around 5% of GDP. If you look on the table to items 2 and 3, these are the big job support schemes, the furloughing scheme. Number 2, the furloughing job retention scheme, and number 3, the scheme for self-employed. A staggering £50 billion cost there, and that's just for 3 months. So you can see it's really critical for the UK economy. How long do we remain in lockdown? Turning to slide 8 and the impact on financial markets. I show there gold, UK gilts, world equities, emerging markets, and UK equities. For the 3 equity lines, the important number is the scale of the recovery. World equities, albeit off a very low base, are up 22% from their low on March 23rd, and this has flowed through to your portfolios. Now, it by no means recoups all of the amounts lost. Remember, this is off a low base. But I think a combination of very proactive central banks and slightly better health news has driven that. Interestingly, through that recovery, gilts continue to rally and gold continue to rise. That's relatively unusual. Normally in a risk rally, gold and gilts underperform. I think that's an indication that there are still risks to come as the backwash from the global economic disruption flows through into profits and earnings. On the right-hand side, I showed this last time, you can still see that red line there shows us the fastest decline of a bear market in history, but also a very rapid recovery. That indicates that markets are thinking this is a relatively short-lived phenomenon. We need to be careful and cautious here. Finally, on 9 and 10, the other 2 indicators have been watching. One, equity volatility is gradually falling, which is encouraging. The VIX now 39, below the 40, as I record this interview. Most importantly, on the right, I indicated to you that Treasury bond volatility, that's UST bonds, these are the anchor of the global financial system. Volatility there is very dangerous. That number has come down very nicely, and we owe a lot to thank the Federal Reserve for that support program. Finally, other assets. I reported 2 weeks ago that absent emerging markets, G7 currencies were relatively stable. They remain so. You can see on the left of slide 10 that dip in the pound has largely recovered in blue. The euro, China and Japan within 3 or 4% of the US dollar over the period of the crisis, which is a thankfully low volatility. Also on the right, corporate bonds continuing to behave well. Again, we owe a lot to thanks for the intervention programs by the Federal Reserve. So where does that leave us today? We've benefited from the recovery in our equities and in the additions to credit that we've made over the last 2 weeks. We held large positions in gold and a high quality corporate bond portfolio, but with additions, as I indicated. However, we have remained underweight equities, not by much, but we are still cautious. And that caution is because we think the second round effects from the world economy that I showed you earlier in these slides will come through to haunt us in earnings and dividends. So amidst the rebound, a note of caution. Thank you.